Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Pccw Limited Annual Report. Pccw Limited provides a wide range of businesses and services across various sectors. The company operates through three main segments: HKT Limited, HKT, Media Business, and Other Businesses. The HKT segment offers telecommunications services such as local telephony, mobile, enterprise solutions, international telecommunications, and network-based telecommunications services. It also provides outsourcing and contact center services, IT solutions, and technical consulting and engineering services. In addition to telecommunications services, the company's media business segment offers free television, pay television programs, interactive multimedia, and mobile video on demand and advertising services through its OTT platform. This segment also publishes directories and distributes media content. The Other Businesses segment is a diverse group that includes broadcasting and related services, management and engineering support services, customer relationship management and customer contact management solutions, and content-related services. It also offers over-the-top video services under the View brand and sells customer premises equipment and related solutions. Furthermore, Pccw Limited engages in the sale, distribution, and marketing of telecommunication products and services, provision of data services, system design, project management, and managed services. The company also provides computer and IP/IT-related value-added services to business customers, operates a customer loyalty program and online merchandise sales, and offers content production, talent management, and entertainment business. In recent years, the company has expanded its services to include e-commerce, travel, insurance, big data analytics, fintech, and health tech services. With its diverse range of businesses and services, Pccw Limited is a leading provider in the telecommunications and media industries. The significant increase in Pccw's stock price over the past year can be attributed to several key factors. Firstly, the company's strong financial performances played a crucial role in driving its positive returns. In 2025, Pccw reported a 7% increase in revenue for the first half of the year, with a notable 116% surge in consolidated profit and a 51% rise in EBITDA from its over-the-top OTT business. The robust performance of View, Pccw's video streaming service, was a major contributor to this growth. View saw a 27% increase in subscription and advertising revenues, adding 1.3 million net paid subscribers and reaching a total of 16.8 million, with 13% subscription revenue growth. The company also declared an interim dividend of 9.77 HK cents per ordinary share. Furthermore, Pccw's full-year 2025 results revealed a 7% rise in revenue, with consolidated profit climbing 35%. The OTT business continued its strong momentum with a 56% surge in EBITDA. Additionally, the company recommended a higher full-year dividend of 38.25 HK cents per ordinary share, reflecting confidence in its cash generation and contributing positively to shareholder returns. The growth in View and media operations was another key driver of Pccw's improved profitability and overall positive performance. The expanding subscriber base, enhanced operating efficiency, and strategic content investments in View were major contributors to this growth. Overall, the combination of strong financial performances, dividend payments, and growth in View and media operations has driven Pccw's significant increase in stock price over the past year. Pccw Limited maintains a market capitalization of $48 billion, broadly in line with the industry peer group. Pccw Limited trades at a lower price-to-book ratio of -24.21 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 88% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 6.18%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth for a company can be attributed to several key factors. Firstly, the expansion of its subscriber base through the addition of new subscribers and the introduction of new content has contributed significantly to revenue growth. The launch of regional streaming bundles with popular platforms such as HBO Max has also been a major driver of growth. In addition, the company's focus on established markets has enabled it to achieve economies of scale, further boosting revenue. The introduction of personalized services and best-in-class customer experience for premium consumer offerings has also contributed to growth. Furthermore, the continuous upgrades to digital infrastructure and accelerated integration of artificial intelligence across services and operations have improved operational efficiency. The growth in key financial metrics such as total revenue, EBITDA, and adjusted funds flow (AFF) is a testament to the company's success. The HKT segment, mobile product sales, OTT business, and other businesses have all experienced significant growth, with some segments experiencing increases of up to 142%. On the other hand, the primary drivers of revenue decline can be attributed to softer advertising revenue amidst restrained corporate advertising expenditure and unsatisfied long-term fixed-price contracts. The pay TV business revenue has also declined by 2%, contributing to a decrease in overall revenue. Overall, the company's focus on expanding its subscriber base, introducing new content, and improving operational efficiency have been key drivers of revenue growth. However, softer advertising revenue and unsatisfied long-term fixed-price contracts have contributed to revenue decline. The company's debt level has seen a significant surge over the past period. According to financial reports, gross debt rose by 13% from $52,393 million to $59,180 million. This substantial increase is not limited to just one aspect of the company's borrowing, as both short-term and long-term borrowings have also seen an uptick. The rise in long-term borrowings may have a ripple effect on interest expenses, potentially leading to changes in this financial metric. As a result, stakeholders should closely monitor these developments to gauge their impact on the company's overall financial health. The company's performance varied across different segments and regions in the past year. On a positive note, the media segment saw an increase of plus 4.7% in revenue and plus 3.2% in EBITDA from 2024 to 2025. The HKT business segment also performed well with a plus 1.9% rise in revenue and a significant plus 30.8% jump in EBITDA. In terms of geographical performance, Hong Kong saw a notable increase of plus 7.3% in revenue, reaching $31,327 million. Mainland and other parts of China experienced a growth of plus 9.8%, while Singapore's revenue rose by plus 11.1%. These regions demonstrated strong financial performance for the company. However, there were some areas that underperformed. The businesses segment saw a significant increase in revenue but minimal improvement in EBITDA, indicating potential inefficiencies. Additionally, restructuring costs weighed heavily on the company's finances, amounting to $113 million. Management is optimistic about the company's outlook, citing several key initiatives that will drive growth. The primary focus is on establishing new growth engines through investments in established markets, with a goal of achieving economies of scale. This includes launching a regional streaming bundle with HBO Max and promoting artiste performances. To deliver captivating content and deepen viewer engagement, management plans to leverage high-performing titles and advanced analytics. Additionally, the company will expand into high-growth Southeast Asia markets through partnerships with local carriers. These efforts are expected to boost subscriber growth and increase reach. In the entertainment sector, management is focusing on subgroup and solo artiste performances to build momentum for group concerts in 2026. This strategy is expected to lead to a rebound in financial performance next year, driven by a strong lineup of group concerts and a revitalized talent roster. The company also aims to elevate its international profile through participation in major productions and global events. Finally, management is actively reviewing the company's capital structure to balance shareholder return with sound capital positioning. This includes continuing to invest in digital capabilities while considering market conditions. Overall, these initiatives demonstrate a clear strategy for growth and expansion, driven by investments in established markets and new technologies. The company's dividend payment history is a notable aspect of its financial performance. According to the provided information, the company has indeed paid dividends in both 2024 and 2025. This indicates that the company has been committed to returning value to its shareholders through regular dividend payments. The consistent payment of dividends over these 2 years suggests a stable and reliable approach to shareholder returns. That concludes the financial summary for PCCW Limited. Feel free to comment below, and I will be happy to answer them when possible.